Good evening, everyone. My name is Dr. Brenda Obondo, and I'm a member of Education Committee, KME SACCO. I'd like to welcome all the members and any doctor online. Feel free to be here with us on this webinar. It's the second in our series on personal finance and investment today. Feel free to share the link even as we onboard more people. Share with your colleagues. The more the merrier. A little housekeeping before we start off. Kindly, any questions, please post them on the Q&A as opposed to the chat so that your question is not missed and for ease for the moderator. And we also have a survey at the end of this webinar that we'd love for you guys to fill. It gives us very useful information. So allow me to introduce our moderator today, Dr. Edmond Obat. He's a member of the board of the KME SACCO. So Dr. Obat will take over the agenda from here. Dr. Obat.
Yeah, thank you. Thank you, Dr. Bondo, and good evening or greetings from wherever you're joining from. To all members of the SACCO, other members who may have joined us, of staff of the day. Welcome to what we envisage to be going to be a very wonderful session. And as Dr. Bondo has mentioned, our topic today is on personal finance and investment. And we have our speaker at hand. So without much further ado, I'd like to introduce our guest speaker and then hand over the session to him. So our speaker today is Mr. Alex Kibebe, who is a corporate trainer and a keynote speaker with over 14 years experience in both training and consulting at both individual and corporate levels on matters finance and investment. And his personal mission is to transform the economics of both individuals and corporates successfully. He is a founder of Rubiani Wealth Management Limited, which is an investment company that provides a range of investment services. These include training, provision of research information for investment decisions. And over the course of time, the company has trained over 1,000 individuals. This is since it was started in 2018. Alex is also a guest speaker on various TV and radio shows, particularly in discussing matters largely around personal finance and investing. He has authored several publications and booklets, and some of his works include Successful Trading in the NSE, Fixed Income Investment Opportunity in Kenya, and the Rubaini Investment Manual. Alex has a degree in economics from the University of Nairobi and is a member of the Chartered Institute of Securities and Investments in the UK. So as you can see, Alex is very well, has a vast base of experience on the matter, and is my pleasure to invite him to share with us what he has, and then we will engage in a Q&A session after. So welcome, Alex. And as Alex sets up, Bonda said, let us engage using the chat box. Remember to post your questions in the Q&A. We'll track them, and at the end of the presentation, we will engage the speaker to provide us with some answers and insights. Thank you. Welcome, Alex.
Asante sana Daktari, and thank you for giving me this opportunity just to be able to share what's in my mind. As the Daktari has mentioned, I've been in the investment world for quite some time. Initially, I just used to provide investment services in case you want to, particularly in paper assets. So in case you want to buy stocks, you want to buy a mutual fund, you want to buy a treasury bond. We had a company that used to provide that as a service. But over time, we morphed to being more of a training and providing investment knowledge. So I've been training for some time, as it has been mentioned. And I'll just be sharing some of the things I've learned over the years, and I hope that it will be of great help to you. Now, granted that the topic is really wide, when you talk about personal finance and investments, it's covering quite a a wide range of things. So what I'll do, I'll just give it in general and hope that through the Q&A, we'll be able to cover a lot of the questions that you may have on the same subject. Yeah, so allow me to share my presentation. As I get started, as I've mentioned, I have done this training to quite a number of people. And the first question I always ask the groups that I've been talking to is, what does financial success mean for you? And I have received a range of answers, and I'll just summarize them. This may not be it, and I don't know what financial success means for you, but it may fall among this or it may not, but allow me to share what has been the common answer in all the areas that I've been speaking. So a lot of people will say, you know what, I don't want to be working to pay my bills. I want to get to that space where I work, yes, but not to pay my bills. And so what that simply means is that, you know, that I have gotten enough passive income or income that is not made from my work, my sweat, and that income is able to cover my bills, so that what I do every day is simply, you know, just either giving to society or just working because I love to work. Another set of people are talking about financial security. There's so many ups and downs. People get retrenched. You know, situations come and our incomes are hit in one way or another. So they're saying, you know what, I want a buffer so that whatever comes my way in my journey of life, I'll be able to cover this well. So for them, as long as they have that buffer, they feel secure. There's still another set of people who have dreams. You know, you're saying, I want to travel the world. I want to start a multi-billion shilling business. I want to get into politics. You know, politics costs a lot of money. I want to, you know, I want to start a big hospital. Whatever your dream is, it costs a lot of money. And so you're saying financial success, you know, is when I'll be able to raise the capital and pursue whatsoever dream that would be. It could be inheritance. You know, you have kids and you want to leave them a substantive inheritance. Yeah. So all these are answers I get to the question of what financial success means when I ask various people. And as I was doing my research, as we were doing training preparation, I came across another research. It was actually by Retirement Benefits Authority, not a Kenyan, not from Kenya. If I'm not wrong, it's from the US, and they wanted to find out of 100 people who leave college and get a good job, where are they at the point of retirement? And the results are really interesting. So they wanted to know, out of 100 people, they leave university, they get a good job, where are they at the point of retirement? Some of them are wealthy, they are rich. What that simply means is that they have amassed a sizable amount of wealth, so that they're able to do so much of their dreams. If it is to travel, if they have real estate, they have a lot of real estate, they have companies. That is what we call rich. Yeah, and different, you know, countries have a definition of rich. I don't want to get into that. The second category of people are people who retire and they are able to maintain the lifestyle they had when employed. And that's the money they make, the passive money or the money they make from other sources that are not their employment, is almost equal to the money they were making when they were employed. And so what that means is when they retire, they're able, if they were changing their car every 3 years, they're able to continue to do that. Whatever they were able to do before retirement, they're able to continue with it. There's another set of people who, though they survive financially after retirement, they have to take a financial dip. You know, they have to move houses. Either someone goes up country, or, you know, they have to just simply down their expenses. And as we all know, after retirement is when your expenses go up. You know, that's when you want to enjoy life, maybe travel around, your medical bills will go up. And so this is not the time you want to take a financial dip, but there is that percentage. Then finally, there's a percentage of people who after retirement are not able to survive financially on their own. And so they either have to depend on their children, they have to get another job. And this research found that only 1% or 1 out of 100 people who college, get a job, will be wealthy at the end of the day or at the point of retirement. The research found another 4 out of 100, 4% are able to maintain their lifestyle, but of course, probably not as wealthy, then 15 out of 100 have to change their lifestyle because their income has substantively reduced after retirement. And finally, a whopping 80% or 80 out of 100 could not survive financially. And so they had to either depend on children, get another, basically they were broke at the point of retirement. And this has really brought us to really reflect and think, how come? Of course, when they are leaving college, you can believe that they all believed and knew they would succeed financially. They were optimistic. We all leave college, we all leave campus feeling, I want to conquer the world. But what happens so that many of us fall along the way, so that only 1 out of 100 really get wealthy and fulfill their financial dreams or desires? And I don't know what answers you may think from that. I don't know what you feel could be your answers, yeah? And I just want to share the things I have found. Yeah, you can be free to share in the Q&A, but the things that we found from our research that keeps a majority of us from either finishing well or finishing really wealthy, fulfilling all our investment desires and dreams are a few things, and I'm going to mention them quickly. The first one is that many of us lack goals. They lack investment goals, they lack plans, and they lack a system and a model. Let me explain this quickly. Financial goals, of course, is what we dream to achieve through our financial journey, yeah? And plans get us from where we are right now and channel a path to where we are going. And I'll share a plan briefly as we come to the end. Finally, a system or a model. We always say we are people of systems or models. We went to school, you are told there's a timetable, there's a bell that rings, you move from one class to the other. Exam period, everything was set in a system. Yeah, all the way to college. Then after college, we get employed, and you're told, this is what you do, this is what we all work in a system. Unfortunately, at the end of the month or at the end of a season, you are paid a check. And for most of us, there is no system. I mean, you can do anything with the money. You can give it to your mother, you can give it to charity. There is no system around your money. And a lot of us waste a lot of time and opportunity because we've not fixed a system around money. And I'll be sharing a system that you can consider when it comes to your investment journey. So the other thing is many of us don't have the right knowledge. We have knowledge about a lot of things that we do, but not money knowledge or not the right knowledge. And because we don't have the right knowledge, we end up getting into the wrong, we end up much time to the right stuff. And this can really, slow us down in our journey. Is erratic investing, called this the Kenyan way of investing. Yeah, you hear people are into agribusiness, doing bamboos, we are all there. We hear it's oil business, we jump into that. We hear it's a land here and there with no plan or organization. We jump into these things in an erratic way. And at the end of the day, when you look at your investment journey, those breaks, wrong decisions, or unplanned and uncalculated decisions is what leads many of us to not ever fulfilling our investment desires. Another thing is a lack of belief in ourselves. And what that means is that when discouragement comes along their way, they kind of validate our lack of belief in ourselves and we give up along the journey. Yeah. Another thing is bad experiences. Maybe you invested in stocks, your money got burnt, and you say, you know what, this investment thing's not for me. Alternatively, maybe you can, got into a land deal. Maybe the land was not what you thought, or probably didn't go through and you lost some money in such a transaction, and you give up on your journey towards, owning land in your investment journey. And so what I'll be speaking is trying to correct some of these failures that we go through in our investment journey. The first thing is we'll be talking about how do you write your goals. Number two is how do you come up with an investment plan. The second thing is how we want to demystify the investment world in the few minutes that we have. We'll probably not get into detail, but understand how does investment world work, or what opportunities are there available to you. The third thing is about a model. Again, very simple. We meet that as we walk along. The other thing that is important is each and every one of us has to find some form of accountability. Because as we learn, two of the greatest obstacles to our financial success is simply indiscipline and procrastination. Many of us keep buying time. Many of us start and we invest this month. Next month we don't. That up and down requires accountability. So we need to have an accountability system for us to get there. Finally, as we see results, as we invest successfully, we see our funds, our wealth grow. This becomes a motive or a motivation for us to keep investing. And I've seen a lot of people, we get started. Again, I mentioned I'm an investment consultant. We start the journey, we set up a plan. And as the year ends and they see the distance they've covered, most people after the second, the third year, they've got the rhythm, they're really excited, and they can keep going on until they get to their investment goals. So we are going to be talking a little bit about these things, and I might just rush over them so that during quick Q&A, you can be able to ask and I can be able to answer some of the areas that you want me to highlight. And so the first thing, of course, we mentioned is writing down your investment goals. And what we say is that investment is not an end in itself. Most people will invest because they know investing is a good thing. Maybe their mother, their father told them to invest. Maybe they keep hearing people talk about investing. Investing is healthy, it's a good thing. But the truth is that investment is not an end in itself. Unless you have set specific goals that you are pursuing through your investment journey, chances are you'll give up along the way. Again, you can't tell whether you're doing well or not. And so the first thing that we advise for you is simply to write down your investment goals. And it doesn't matter where you are currently. You may be in debt. You may be probably in between jobs. Maybe your practice is not delivering as much. You're struggling to meet your bills. You need to put all that aside and set long-term goals, and let those goals be the motive for which you are investing. Because you say all these other things are temporary, but your investment journey is probably your whole life long. And so forget about those temporary situations you are in and write down your investment goals. And in Rubiani, we've categorized goals into 7 categories. The first one is a home. Probably over 90% of the people I've spoken to prioritize a home as a first goal for their investments. And there are various reasons for this. Many of us feel that, without a home or a space, you're nowhere really. Maybe you feel a home gives you a place of belonging. A home is able to take rent, which is a big portion of our income. A home gives you an ability to design it and to, make it the way you want. Again, a home helps us so that no matter what happens in life, at the worst, I have a roof over my head. So there are various reasons why many of us will prioritize a home. But irrespective of the reason, I think a home is an important investment. And when it comes to a home, there are 2 major decisions you need to make. Number one, will I pay cash or will I invest and pay through deposits and not take debt over it? Or will I pick a mortgage or some form of loan to be able to build? That's the first decision. Will I pay cash or will I take debt? The second decision is, will I build my house or will I buy a ready-made house? So those are the 2 major decisions that you and I have to make when it comes to home ownership. Each has its advantage over the other. I mean, when it comes to buying, of course, if you're using a mortgage, it's easier to buy when it's a ready-made home. Again, most ready-made homes have amenities around them. There's probably a road that is well made. The security has been well set up. A home is also easy. One that you've purchased is also easy to dispose. So the day you want to change houses, it's much easier to sell in most cases. Again, building a home at the end of the day, it might be cheaper because remember, there are no middlemen, there's no contractor or developer. Then the second thing is that you can do more build a house in a modular way. You start, not finish completely, then you continue finishing, maybe you extend the house to fit your family as it grows. So it has that flexibility again. So each side has its advantage. So for you, it's up to you to decide what direction I go. You don't have opportunities. There are people who have debt. Debt is available for them easily. And so if debt is available for you easily and cheaply, then maybe a mortgage might make sense. Yeah. And then there are some, inherited a good piece of land that it's at a convenient place. So maybe building, so different people have different opportunities. So you need to check, the opportunities that are available for you and decide which direction to go. Yeah, so again, what we say is that the most important opportunities are to you, make the decision as possible. Moving slowly. Us take time before we make this. Then it becomes, or we build the house when maybe the children are grown and all kind of thing. The second thing that a lot of us put as a goal is passive income, and I've talked about it. We've said, just a minute. Sorry, I see it's not my internet. I just wanted to confirm. And so the second thing is passive income. And passive income is simply the money that we make without applying our thoughts, our energy, our time. Again, maybe at the very beginning, it might involve that, but after that, it's simply money working for you. In other words, you put money in an investment and it's a lot of your effort and time. And so many of us are looking to have some passive income because it's only this passive income that replaces, our current income. And that's the only way we can be able to retire early. That's the only way we can amass wealth to whatsoever it is that is our investment goal. And so there are various things there are various ways that you can have passive income. Maybe I can mention a few as we walk along. Some I'll mention as we walk along. Is, you build a house, then you're able to pick rent every month. That's passive income. You can get into things like treasury bonds, very good for passive income. You can get into the annuity. You can, do something like private equity, for example, where you own a business. For example, you own a hospital and you're not involved in the everyday activity, but you get a profit from it. So all these are ways that you can build passive income for yourself. The other one is education and our children. Again, it's so important for us to plan for our children. And this has been my experience as an investment consultant. Put so much money on our children. That's a major reason why many of us at the point of retirement, we don't have much to show because we didn't plan children. And so when they came, of course, sacrifice to give their all. At the point they are leaving the house is probably the time you are getting old and thinking of retiring, and you've not done much for yourself. And so we say you need to plan for your children so that as you are giving the best to your children, you're also working your investment plan. You're also working towards fulfilling other investment goals. And that is why it's so important for us to plan for our children. Another one is passive income. Most people imagine when you take on the investment journey, you have to live a very frugal life. Lazima ujinyime, nothing to yourself. But that is far from true. The truth is that success when it comes to your personal finance and investments has more to do with planning than even sacrificing. Of course, there are sacrifices. You have to delay your gratification here and there. But with proper planning, you can be able to fulfill long-term and short-term goals. And so if you have a goal, you want to take your family on holiday every year, you want to improve your car, you want to upgrade your house, as long as you've planned this thing well, and it's going side by side with more long-term and probably more important goals, then it's a goal that you can be able to pursue. Another thing is a capital venture. We've talked about this. Capital venture is anything that will require you to amass a certain amount of wealth. For example, you want to start a business, you'll need some capital. Maybe you want to start a farm, you want to travel, you want to get into politics, anything that you to the other thing is an emergency and having the right insurance. Safeguard our journey. Anytime we take on the investment journey, we need to protect that journey by having an emergency fund that is able to cover any emergencies along our way, and the right insurance again for managing our risks. Then finally, very important is our retirement. And we say retirement is a sum total of making the right decisions along the way. As you buy the house, as you build your passive income, when you've set enough emergency fund and insurance, you're taking care of your children by planning well, all these things work towards helping you retire early and retire wealthy. Yeah, so that's it. And so one of the challenge I would say, if you have a goal, if you've set your investment goal well and good, but if you've not set investment goals, very clearly and articulated goals, you've written down in a book and you say, these are my investment goals. That might be my first challenge, that you sit down across those 7 categories I've mentioned or any other and have those goals, because those goals will be the basis for your investment journey. So the next thing we'll talk about, allow me to check the chat 1 minute. Okay, thing we'll talk about and start on your investment journey. The first thing you'll discover is that it is not just financial decision. It's very emotive, very cultural. The people around us when it comes to our personal finances, what we saw when we grew up, all these things come into play. And it's important for you to be able to understand these factors. There's a book called The Art of War that is very popular. I think it's used in almost all armies. And it can probably help us to see, because we say that, if we know what we are against and we know ourselves well, then we can be able to win in any war. And it's so important for us to know and to be, to be cognizant of the things that work against us when we invest. I'll mention a few very briefly because of time. Some of the factors, there are some factors, but I'll mention a few. The first thing I'll say is success in investments is just 2 things. If you're able to have a clear investment plan and you're able to be consistent in your plan, then chances are you will succeed financially. In fact, I remember sitting down one time, it was Martin Otieno-Oduor, the former CEO of KCB, and he said something interesting that I would want to share. He said that when he had a board of directors in KCB, and one of the members was a pilot, and the pilot told them that what pilots have been taught is to trust in their instruments. So when they are 3,000 feet above ground, a pilot is told not to listen to noise. There's a lot of noise in the cockpit, but they are told to look at their instruments and to trust their instruments. And so when the plane is so noisy and there feels noises here and there, but his instruments are telling him or her that the plane is moving, in the right direction and everything is fine, you'll see a pilot relax. But on the flip side, the pilot looks at the instruments and they're telling them there's trouble. It doesn't matter how well the plane is cruising. You'll see the pilot panic and step into action. And why was he sharing this, or why am I telling you this? Because when you step into the investment world, there's so much noise. There's so much being thrown your way. There's this person coming and selling you an insurance plan. There's this person coming and convincing you how a particular piece of land is good investment. This one is telling you how to invest in this business idea and this and that. There's so much noise. And a plan is an instrument. We can compare it to a pilot's instrument. That no matter, as long as no matter as long as you look at your plan and you're walking in the direction of the plan that you set, then you can keep away the noise. And so having a smart plan and investing consistently is the 2 most important things when it comes to investing. Well, but the truth is that these things are easier said than done. There's so much that, and so some of the other things that we need to find out. The first thing, and I always give this to people as an assignment, you need to define what we call an investment ratio. What is an investment ratio? An investment ratio is simply the percentage of your disposable income that you set aside for investment. Yeah. Anytime you're making income, you need to set aside money for investments. A story is one told that in a certain kingdom, there were, the king looked for a contractor to be able to bring water into the town because, of course, for whatever strategic reasons. And he had 2 people. One was called Peswa, the other one was called Pendo. So they both got buckets, went to the river and fetched water, taking it to the township, wherever they were taking. And they both had expenses. They paid for their expenses, but there's something that Pesa did that Pendo did not do. At the end of, after paying for his expenses, he set aside a certain amount of money and bought a small pipe from the river towards the city. The next did his buckets, they both did their buckets, Pendo and Pesa. After some time, they did the same thing. Went to everyone paid their expenses, that's at the end of the month or at the end of the payment period. Each paid their expenses, but once again, Pesa bought a small pipe, connected it to the last pipe, heading towards the town. And they went on over and over again. Every month end, Pendo would buy Pesa would buy after his expenses, buy a small pipe connected to the last towards the city. And you can imagine what happened. After some time, Pendo was covering less and less distance because the pipe was just coming closer and closer to town. After some time, it was halfway, and he could do twice as much as Pendo because he was covering half the distance. And eventually, Pesa had a pipe from the river to the city. On the other side, Pendo kept doing his or her buckets every month, just going to the river, fetching water. After some time, he had buckets, he couldn't work, had to push his children, and his story did not end well. And the moral or the lesson behind that story is that as long as we are making active income, as long as we are earning an income, it's important to set aside some money and buy a small pipe or put the money in some form of passive income, so that as you move on and on, you'll get that space where the money you're making from passive income is more than your expenses. And that's when you say you are ready to retire and you can be able to, do without a job. And so it's important. The first thing you need to do is determine what percentage of my income will I set aside to investing. Another important thing is, a lot of us get trapped in the wheels of life. And I've seen this as a consultant a lot. You start off in the right direction. Maybe when you're young, when you're starting off, you are all excited. You've put up all the right things, but life happens. You get married, maybe you start getting children, and you forget about investments and you focus on the things that are important, the things that are urgent, the things that are demanding your money, they are urgent, and forget important things like investing. And so by the time it's hitting you, a lot of time is gone and you start panicking and investing in a hurry. And that's what causes so many of us to make mistakes. And so the second thing you need to do, and you and I need to do, is sit down and find out what are the things challenging my investment journey and be able to address this, because unless we address some of these underlying issues, chances are we'll struggle in our investment journey, and we might be part of the statistics of the people who never eventually get to succeed. And just to mention, again, I mentioned two of the most critical things that keep us from succeeding financially is indiscipline. And we see that the reason why we struggle with indiscipline is because of our upbringing, about our peers, our friends, the people we associate with. They have a way of, getting us into this cycle of indiscipline where we invest this month, we don't have that consistency over the long term. And what we've discovered is some of these habits are hard to break. It can be very hard to break some of these things like indiscipline. Maybe you like debt, maybe you're indisciplined, you've been trying for the last 3, 5, 10 years to be disciplined in investing, and it keeps eluding you. Yeah. And so one of the things I advise as an investment consultant is to find an external way of disciplining yourself. And I'll be able to share that from what we call the decision funnel, that some of these decisions or activities that we know are important, some of the way of ensuring that we remain disciplined is asking ourselves, is it something that I can avoid? And maybe an example I can give is that's something I do. As a family, we shop in the supermarket once a month. Reason being, we've discovered that every time you keep going to the supermarket, you buy more than you have intended. So we do our shopping once with a shopping list. Then any other shopping within the month, we will go to a local kiosk. It's more expensive, but we've discovered it keeps us from buying a lot of unnecessaries. So one of the ways you can ask, the first decision you need to ask is this something I can avoid altogether? Again, if you can't avoid, the next thing you need to do is automate. How can I automate this process so that it doesn't require my discipline to do it? When it comes to investing, one of the things we advise is to put something like a bank order, where you give a bank an instruction that every end month, debit 20,000 shillings from my account and put it in an investment account, be it a SACCO or a money market product. And we'll be talking about this product shortly. So when you do that, you are not depending on your own indiscipline. And so even if you're not the most disciplined person, you are using some of these external ways of remaining disciplined. Another way is delegating. Find someone to be able to do the things that you know are important, but maybe you don't have the time, you don't have the skill, or you don't have the discipline to do. And a good example is looking for maybe an investment consultant like myself, for example, in making decisions on how to pick stocks, or to be able to review some of those things. Ask yourself, can I delegate? Do I have to be the one to do it? Especially the things that you keep forgetting or the things that you are indisciplined about. Then finally, of course, if you can't avoid, if you can't automate, if you can't delegate, you simply have to focus on that thing. But by the time you're focusing on the things you need to focus, you've already removed a lot of important decisions through delegation, through automation, and through avoiding. So when for you, if you struggle in indiscipline, because we all struggle with some level of indiscipline, you need to ask yourself these questions. Is it something I can avoid? Is there a way of automating? Is there a way of delegating, finding someone else to do these things that are important? Or is it something that I simply have to be the one to do it? And for those ones, you simply have to be the one to do it. And so that's one of the ways we try to hack in discipline. The other thing is procrastination. Procrastination is that thing of saying, I have some financial issues now. Let me start investing next year. And you keep saying that, and 10 years come and go. Yeah, I'm still young. Maybe I can start investing in the next 3-4 years. I'm still doing my master's. We have every excuse to keep us from doing important things. Some of those are valid, but in truth, if some of these things are important for you, then you can't afford to procrastinate. And this is something, again, I find with so many people. I take them through a training like this, and they're all excited and say, you know what, I will start investing. 2 years down the line, they've not started. When we talk, it's simply an issue of procrastinating. There's no major reason as to why they've not started. And so some of the things that we have discovered when it comes to hacking procrastination, when we meet people who struggle with procrastination, it's just to remind them, number one, there are two types of things. There are urgent things that are always demanding our attention, and they're important things. They might not be demanding our attention, but they're important. Things like eating healthy, things like investing and saving, like we're talking about today. And what we determine is that the reason why urgent things take priority is because they have a deadline. They have some external pressure that is causing us to place it, as priority, giving it urgency when it comes to our finances. And so one of the things you and I need to do is find a way of either introducing a deadline or some form of pressure on the things that we procrastinate on. Yeah, I always give an example of myself. When I started training in 2018. I never felt confident enough, and I kept procrastinating. And when I came across some of these trainings, I decided, what, I'll be training once a month. I looked for some designer. They made posters for the whole year, and I just released them. When you release a poster, you have to do, for example, if it is a talk like this, once the poster is out, once you've decided, I just simply have to prepare the talk and do it. And so those are external ways. How look at the things that you're procrastinating about that are important and find, how can I create a deadline or some pressure? I have a friend of mine who I remember, they were procrastinating on investments. I sat down with him. I know he loves soccer so much. And so I told him, if you will not start investing in the next 2 months, I'll take away your TV. And trust you me, within 2 months, they had already started investing because their love for soccer could not allow someone to come and carry the TV. So these are some of the things that you can do to ensure that you have pressure on yourself. And so those are the two major things that you need to look out for. One of them is procrastination, and the other one is indiscipline. Yeah, so allow me to talk a little bit about debt. Again, I can't get into it a lot, but debt is a very important part of our investment journey. There's good debt and bad debt. You know, good debt is what we say that when you borrow money, you're able to return or repay the money from whatsoever you did with the borrowed money. So for example, you started a business and just one second. Okay, so for example, you get a debt, get some loan, start a business, then you're able to repay the business from the profits from the business. Or get a loan and pay a mortgage, and the money that you are paying for rent, now start, when you compare that, you can start seeing that in the long run, you're saving. Whatever you've money in is able to repay the money that you have borrowed, and of course give you with some spreads. But simply the money that you borrow and you have to pay from other sources of income. And so for most people who struggle with debt, it's an issue of delayed gratification. I mean, you don't delay your gratification. Those are discipline issues. And to be honest about it, you can talk to a counselor, someone who can be able to sit down, look through your debts from an external side, and be able to give you honest solutions to the situation that you are in. And so it's becoming more and more important for us to talk about debt because it's becoming a big issue, even in our own journeys. And so when you've sat down, you've gone through all the things, you know, you've hacked discipline, you're now more organized, you are no longer procrastinating, you've determined what my investment ratio is, and you've started already. The next important thing is to understand the investment world, yeah? And so just be talking a little bit about investment opportunities that are available. And so we say that we start with goals. That's where we started. You've written goals. You start a home, I want to build rental property. I want to retire young, whatever goal it is, and come up with a plan. So the between where you are right now and fulfilling that goal is what we call it. And investing is simply investing simply means what the investment goals we have, we can't with our every month. It's not something that with your month on month income, know when I get income this month, I will buy. That's not an investment goal. It's the kind of goal that will require you to save up and invest over a substantive period of time. And we say investment is the process multiplying your money to be able to get to the funds that you want to fulfill whatever goal it is. Yeah? So allow me to skip that because of time. And I just want to mention a little bit about investment goals. I mean, investment products. So what we say is that to help us save and more money, the investment world has developed what are called investment products. And different investment products will have different purposes. They'll have different risk return element. And so the first thing we want to do is categorize investment products. There are two ways we categorize investment products. The first one is a risk versus return. And what ideally, general rule, the products that will have a higher return or a higher possibility of return will also carry a higher risk. In other words, the kind of investment product, put your money and multiply it fast, also you can lose the money that you've put in the similar speed. So the products that can give you a lot of income, can multiply your money fast, will also carry a risk that you can lose money. On the flip side, the products that have very low risk will also have a lower return. So the products that your possibility of losing money is very low will also give you a very low return. And so when you look at that continuum, you can be able to see the categorization based on that risk return categorization. And so we say that, you know, banks, mutual funds, some types of mutual funds, treasury bills and bonds, they could be they are conservative, so your capital is safe, but the returns are low. As you go to moderates like real estate, you go to balanced funds, you discover that The risk, again, is balanced. There's a balanced risk and not so huge return. But when you step into shares, into products like private equity and Forex, now you discover that the risks are higher, but the possibility of a higher return, of multiplying your money times 2, times 3, are also higher. So private equity, maybe I can define at this point. Private equity, as I had mentioned, is when you own a business or a venture, but you're not involved in. When you talk about private equity, most of the very, very wealthy people, converted their businesses into companies that can run on their own. And so they're just making dividends from those businesses. So that's a form of private equity. So that's one way of categorizing investment products. The other way of categorizing investment products is based on the reason as to why you're investing. There are types of investment products whose aim is to accumulate or to multiply your money as fast as possible. We call those accumulation products. They have a risk associated with them, but they can multiply your money fast. The second category of investment products protect your wealth. The whole idea when someone is getting into products, the reason they are stepping in is to protect their wealth. And so when you've grown your wealth to a couple of millions, you're now less willing to put the money in risk products because you want to ensure that your fund doesn't get depleted through risk. Protection products. Finally, they are what we call income generating products. These are the products that invest your money and they give you a return. Yeah, I give an example of real estate. Investment can be a real estate product, and then now from a rental property, the rent that you receive is a form of income. The product shortly. So those are the two major ways that you can categorize investment products. Now, in a few minutes, I want to rush through these investment products. The most common is a bank. We all have banks accounts that we put our money. Most of the times, banks are for a transaction. That's where we get our income. That's where we pay our expenses from. Banks will not give you a good return as a default. Although when you have a lot of money beyond maybe beyond 5 million and above, you can be able to negotiate good return on your investments. Just a minute. So a good return on your investment from what you call tier 2 banks. Tier 2 banks, your family bank, Chase Bank, the banks, what you call tier 2 banks, they can be able to give you very competitive rates when you have a substantive fund that you're investing with them. But for most of us, our banks, even if it's deposits, they will not give us a good return on money. And so for most people, our advice is use a bank for transactions. That's where you get your money, that's where you pay your bills. But we'll talk about investment vehicles as we walk along. The second investment, so we are trying to move from the lower risk products to the higher risk products. The second very common product called treasury products. Treasury products are products that are issued by the government. It's the way the government borrows money from the general public. There are two major ones. There are treasury bills and treasury bonds. Quickly, treasury bills are the investment products issued by the bank for a period less than 1 year. So there are only 3 types of treasury bills. There is the 91-day treasury bill, that's 3 months. The 182-day treasury bills, that's the 6 months. And the 364-day treasury bill, that's the 1 year. Those are the 3 bonds only available. And the thing about bonds is they determine price through auction. Currently, the interest rates are about for the 3 months one is about, the 91-day one is about 7.5. The 6 months one is around 8.5 or thereabout. Then the 1 year one is currently at 9.8%, which is very competitive again, because the government is borrowing a lot, the interest rates have gone up. Yeah, so you borrow, if it's below a year, it's called a treasury bill. If it goes beyond a year, it becomes a treasury bond. And treasury bonds range from 2 years all the way to 30 years. The major difference, number one, is that when you're buying a treasury bill, they pay interest once at the very beginning. So if you buy 100K worth of treasury bill, 97%, if your interest is 3K. So you pay 97. So at the end of the term, if it's 3 months, 6 months, 1 year, the government pays you 100K or the amount that you agreed. It's called discounting. Basically, they're giving you your commission at the very beginning. But when it comes to a treasury bond pays interest every 6 months. So though interest rates are given per annum, all interest rates in the financial world are per annum or per year. They pay out dividends every 6 months. So half your interest for the year is paid every 6 months, half the interest. The other thing is that for treasury bond, you can sell. So maybe you buy a 10-year treasury bond. After 2 years, you want to get rid of it. There's a secondary market or the Nairobi Securities Exchange. You can sell it to another buyer who will buy it and continue earning interest for the remainder of the period of the bond. Another thing is that treasury bills and bonds will attract a withholding of 15%, but there are some incentives on longer bonds. It goes all the way to 0. The long bonds more than 20 years, they're called infrastructure bonds. They are 0 tax rated, so you don't pay tax, you don't report. And so those are some of the differences between treasury bills and treasury bonds. Treasury bonds are really cool because their interest rates are high for people who are investing long-term. Remember, we talked about passive income, very ideal for passive income. Currently, interest rates are actually above 13%, between 12 and 13, depending on how long. The longer it is, the higher the interest rate. We had a treasury bond sometime around 2 months ago, and the interest rates were around 13.4.5% per year. That is a substantive return on investment, very real. Even real estate will give you such a return. And this is stress-free money. You just give the government every 6 months, they're able to give you your portion of interest. So those are the major differences. There are others that I cannot get into detail. Now, besides treasury bills and treasury bonds, the corporate world provides products very similar to this. So when it's below a year, similar to treasury bill, it's called a commercial paper. So companies like Safaricom, like Airtel, like Britam have issued commercial papers where you can buy in the very similar way like treasury bill, where you are paid money in 3 months, 6 months, 1 year. Again, if it's more than 1 year and it's issued by a corporate, it's called a corporate bond. The major difference between the treasury products and the corporate products is that treasury products are probably the safest way of investing, because a government cannot default on paying an obligation in its own currency. For example, Kenya government will not fail to pay money if it's in Kenya shilling, because they own the Kenya shilling. They'll only produce, they own the currency, so they can always produce to pay. That's why treasury products are safe. But when you go to corporate products, they have a risk associated with them, because you're just investing on the integrity or on the name that you're investing in. And we've seen people lose money through commercial papers and corporate bonds. Like Nakumat had a commercial paper when it was falling. ARM had one. When Chase Bank had issues, it had commercial paper. And the people who had invested, some were compensated partially, some lost their money. And so what you need to know is that when you're going to the corporate papers, there's more risk associated with them than the treasury products. So I'll talk about real estate. Again, I don't want to talk much about this because many of us know quite a lot about it. There are different ways you can get into real estate for speculative reasons. You buy a home or buy land and build a home for home ownership. Commercial rentals, again, you build something for rent. Maybe like there's a lot of my clients are getting into, you know, these container shops. That's a form of commercial rentals. Residential rentals is you build a flat, rent it out, agribusiness land. And there's also buy, split, and sell. Real estate, there are advantages and disadvantages. Of course, you need to be careful. You need to do your due diligence. You need to ensure that you're not overpaying on a piece of land. Always, one of the rule of thumb is always buy value now, not in future. Yeah, not at a road will come here, or you know, there's this facility or that will come here. Always buy, always ensure that the value you're buying is now. If a future value comes, that is good enough. But don't buy land, for example, because of promise of some future thing that will happen. I've seen a lot of people put, you know, a lot of money in some of those wrong decisions. Another thing is the stock market. Just a minute. Just give me around 7 more minutes. I'll just rush through the remaining products. And so stock market, again, stock market shares a very ideal place to invest your money because of ease of entry and exit. You can buy and sell shares at any time. It makes it very liquid. Entry is very low. I mean, buying 100 shares of any counter, if a counter is 5 shillings, it means all you need is 500 bob to start trading in the stock market. Then there's a lot of information about the publicly traded products, makes it so much easier. And then some of the advantages is that, you know, it's easy to buy and sell, I've mentioned, but some of the disadvantages that there's risk associated with shares. Yeah, I can talk broadly about shares. I mean, a lot about shares, but unless there are questions, the most important thing is that the ease of buying and selling. But some of the key things that you have to be careful when you're investing. Number one, you need to know what you're getting in for capital gains. Are you getting in for dividends, or are you speculating? Yeah, determine what you're doing and then look for the products that will assist depending on your strategy. Again, you need to know how to interpret financial statements, or have an, you know, an advisor or an analyst who can be able to give you this information. Then, you know, get a trusted advisor, or even consider foreign markets. You're seeing a lot of foreign markets being easily accessible for the purpose of investing. Then some of the last products is what we call structured products. So there are people called fund managers. Fund managers, all they do is that they have been licensed by the Capital Markets Authority, by the Kenyan government, to be able to raise funds for investing from the general public. So they pull funds, it's like a chama, you know, they just pull funds and they invest the funds in different things. And whatsoever they invest the fund in, the funds, a fund manager can invest in different things. For example, they can invest purely in bonds, it becomes a bond fund. They can invest in real estate, it becomes a real estate fund, or what is called a REIT, a real estate investment trust. They can invest the money only on shares, it's called an equity fund. So depending on where the fund manager puts the money, the fund gets the name from there. And different funds perform differently. And so, as I've mentioned, money market fund invests in what are called short-term paper assets, like bank deposits, like treasury bills or commercial papers, the ones that are below 1 year, the ones I've mentioned. The ones that are more than 1 year, the treasury bonds and corporate bonds, it's called a bond fund. So when you get to a fund manager like Zimele, you go to African Alliance, you go to Britam, you have different funds. Which one do you choose? And it's up to you to determine whether I'll just go into the money market fund, I'll go into the real estate fund, I'll go to the equity fund, depending on what is your risk and what your timelines are and what you want out of your investment. And just to mention quickly about the players, the largest is CIC, it controls 35% of the market. Britam, Old Mutual, they go that way. In terms of performance, again, they all bundle between 6 and 12%. Maybe some of the better performing ones, of the big, I've considered just Tier 1 banks, most of them will range between 9 and 10%. It's important to know that when you're getting to money market, that's the range that you'll be talking about. Balanced funds have not been performing, balanced funds and equity funds have not been performing well over time for various reasons that I can get into. And that's why management are in this product that you're calling money market fund. So, so there are different funds. There's also a final product. I don't want to get much into it. It's called wealth management, which is for discretionary clients. If you have more than 1 million, that's what CMA says, Capital Markets Authority. When you have more than 1 million, you understand your risks. And so there are products for such clients. They're called wealth management or cash management. Different fund managers will have different names, but they take on more risk and give you more returns. So all these are products that you can consider. Others, of course, it's important to understand about pension. Do you have a pension plan? Most people who are employed have a pension plan with their employer. If you're not, there are products called independent pension plans that help you to save towards your retirement. Again, insurance, products like annuities or life insurance that gives you a return. Again, what I would advise is that most insurance a substantive return on your investments. It's so important for you to do your numbers. In general, insurance products protect you. For example, a life insurance, or for example, an education plan. In case anything happens to you, your child's school fees are covered. The aim is to protect such risks, not to give you a return on investments. And for that reason, most insurance products will not really have, they're more competitive for investment purposes. But for risk management, insurance products are good. SACCOs, again, we are all in SACCOs. I won't go much into that, but a good way. They are giving competitive interest rates. They give you easy debt. Remember, we said good debt helps you to move forward. Finally, a business. I hear a lot of people saying, I want to invest in my business. I want to buy a matatu. You know, I want to do get a car hire or get an Uber guy to do my Uber, that kind of business. And that's an investment, but for most part, it's more of a source of income, not investment. Most businesses that people run involve their, their time, their effort, the risks are high. But again, you can do it as private equity so that you're not involved in the running. There are risks associated with it. You need to calculate your risks well. Finally, I can't get much into it, is what you're calling contemporary products, things like Forex, Bitcoins, cryptocurrencies, products that have a sizable amount of risk, but also could carry some good enough returns on the same. There's so much that goes into some of these contemporary products. Unless there's a question, allow me just to skip that. And so our advice when you're coming to invest, you need to understand what a product is, what are the underlying, how is this product working? Number two, is this product regulated by the government? Very important. Number three, do you have enough information about that product to make an informed decision on your investing? And then finally, I always tell people, investing is long-term. Use tried and tested products. This is not a place for gambling. You want to invest in the long term. These are important goals. So use tried and tested products when it comes to your investment. And so, yeah, we've talked about all these products, very important. And the big question most people ask me is that, where do I start or how do I go about it? And in a minute, I want to share about our what the model I had told you, or the system. So this is what we advise most people. Your main income account is probably sitting with your ABSA, your co-op bank, wherever you bank. That's your commercial bank. Whether you are in employment or you're in business, maybe you have your practice and you're fully in business, what you call your income account. You always advise people, open an investment account, preferably either a money market account or a SACCO account. Why? Because you can invest without thinking. Your capital is protected and it assures you a sizable return on your investment. So that's the first thing. Separate your investment money from your commercial account. Open a money market unit trust or a SACCO account where you'll be able to keep your money without thinking. You don't have to do analysis. You don't have to do calculation to invest in this product. And we advise people, again, for reasons I've mentioned earlier, to automate that process. Use a to be able to put your money in this money market or SACCO that you have determined as your investment account. Again, any extra monies you get, be it bonuses, is it locum, any extras that you're getting, now you can be able to throw them in the same investment account. Of course, use some for something else, the rest put it in the investment account. We call this acceleration, yeah? It's helping you to accelerate towards your investment goals. So the next thing we tell people is, from that central SACCO or money market account, now you need to analyze, to think, to look at different investment products and be able to cash from them. Is it the stock market time when a small percentage of the money in your SACCO, again, depending on the risk, don't take a lot of it. Play the stock market, make your profits, return the money to the investment account. Maybe you get a land that is at a good price. Someone is desperate selling a piece of land. You can buy it, look for a seller over time, make some good return the money into the investment account. And we call that multiplying. The process of picking strategic investment products from them as you grow your fund in your investment account. So you buy the stock, sell, return the money in the investment account. You call this multiplier, and I have seen this. This is a game changer. I've seen people who understand this process be able to grow their fund substantively and improve their odds of financially succeeding. Finally, very important, as you establish your investment, have the right insurance and emergency account to protect the journey. Because without this, what happens is that you get into an emergency, you have to break into this money market unit trust or sell some of the products, strategic products you bought at a loss because you have to pay that, whatever it is. So we tell you protect your journey by having insurance, the right insurance, and having an emergency account. Then finally, as you grow your fund through the multiplier and as you invest consistently, you're able to fulfill whatever goals you had, and we call this actualization. So this is a model or a system that you can use for you towards getting to your investment goals. Finally, as I mentioned, it's important to start with an investment plan. That's one of the things I help my clients sit down and come up with a plan. I want to buy land. Depending on your goals, I want to build on that land. I want to build rental properties. This is an example of a plan for Mr. and Mrs. Mutua. They had a plan that over a period of maybe 15 years, with an income of a very humble income of 65K, they're able to invest 25K a month. They're able to afford to build their own home, build some small-time rental properties, and educate their children. At the end of it, they're able to, retire at a good age with rental properties, with having taken away, but it's with a plan. The plan gets you from where you are to where you're going. A plan can be adjusted, but whatever the case, when it comes to investing, you do need a plan. And so in concluding, what I can say is that the longer you wait to do something that you know you should, the odds are that you'll never do it. And so if there's anything you've caught, maybe I've reminded you of something you needed to do, maybe I've given you a new idea about how to go about your investments, maybe there's some place you need to tighten here and there. The earlier you do it, you say tonight, this month, settle on that, get started with your investment journey. And by doing so, you increase your odds of being financially successful. So with that, I'm just going to leave it to that and return it to the moderator so that you can be able to handle some of the questions that have come up.
Okay. Thank you very much, Alex, for what has been a very wonderful presentation. It's a ton load of information. Yeah, so to the members who may have joined in the course of the presentation, do not worry, we will share the recording of the webinar plus the presentation itself with all the members. But now we want to engage our presenter in a Q&A session, just to clarify some of the gray areas or areas we may need further clarity. Again, as the presenter alluded to at the beginning of the presentation, is that this is a very broad topic and we may not exhaust it or exhaustively discuss it in this one sitting. But we do appreciate the membership for attending and for taking your time. So now, Alex, if I'm to direct you to some of the emerging themes from the questions. There's a lot of interest in the money market funds and the treasury bonds and T-bills, and some of the questions, like someone was asking about clarifying the difference between the money market funds and T-bonds and T-bills. I believe you've answered in the presentation, but maybe if you can take a minute or two to run the members through how to trade with the central bank. There seems to be a couple of questions on how they can do that, either individually or do they need to go through a firm? So maybe yeah, quickly as we go through the other questions.
Thank you. Maybe I can handle the treasury win and then I go a little bit into the money market one. So as I mentioned, treasury bills and bonds are sold by the government. Investing in treasury bills and bonds is very simple. The first thing is that you open the account either with the central bank or with an agent of the bank. Almost all commercial banks are agents of the central bank, but you can walk in, like the way I opened my treasury, my account to trade in treasury bonds and bills, is I walked into the central bank. Again, there are central banks around the country. There are like 5. There's one in Nairobi for the ones who are in Nairobi. There's one in Kisumu, Mombasa. Identify the treasury bank that is near you and walk in. You can be sure there is usually never a queue. They'll give you some forms you fill out, and you'll be able to open what is called a CBK CDSC. A CBK CDS now, central CDS simply means Central Depository and Settlement Account. What happens is that shares also have a CDS, but the one you open for treasury is totally different. So if you have a CDS for trading in shares, you still need to open a totally different one, one from the treasury, from the central bank for dealing with treasury bills and treasury bonds. So it takes about 2 weeks to open an account. Then after that, to invest, you just need, number one is that once you open an account, they give you an app, a mobile app, where you can be able to see the bonds and the bills that are available on offer. But you can also go to the central bank, treasury bills and treasury bond sector. Again, they'll tell you what's on offer. For example, for treasury bonds, there's a bond that is on offer at the moment. There are 3 bonds that are on offer at the moment, all ranging between 12 and 13%. So you need to go, you identify the bond that you want, and you apply. Again, take the form to the central bank and say, I want to invest X amount of money on this particular treasury bond that is on offer. So again, of importance to note is that the minimum that you invest in treasury bonds is 50,000 for most bonds. The highest I've seen for a bond is 100K. Every month, central bank is issuing or offering different kinds of bonds. So they can offer one, like the current ones, I think are between 5 and 15 years. So they, for example, in a particular month, they might say, this month we are just offering a particular bond that is 20 years, that's the tenor or how long it will last. So people make a bid and the prices are determined through auction. And that's what I was saying. In the last couple of months, the treasury bond rate has been around 12 to 13%. And so, which is a good rate because again, as I mentioned, the government is borrowing a lot because of expenses that it's finalizing, of course, infrastructure bonds and bonds for that reason. So that's how you do it for treasury bonds. Again, treasury bill, the same thing. Every week, central bank is issuing treasury bill. They're determined by auction. What central bank does, it tells you what were the last week's rates so that it can give you an indicator of how much to expect. Again, I give you the rates where it's ranging. So in summary, go to central bank, open an account. You can open one through your commercial bank. Once you open, you can be able to apply for a treasury bill or bond that is on offer at that particular time. Or you can wait for the one that you feel is a good return for you. Now, when it comes to money markets, again, the difference between treasury bills and money market is fund managers, the people who issue the money market, the funds, the money market, equity fund, money market fund, a bond fund. The people who offer those are middlemen, they are brokers, they are in-betweens. What that means is that they pick money from the general public and then invest it in what we are calling primary products, products like treasury bill. So they collect their money and then the pooled funds are able to be invested in treasury bills or commercial paper or real estate products that maybe require so much money so that when we come together, we are able to do these things. So the money market is simply a middleman. They pick money from the general public and maybe give a bank as a loan and they are able to get good returns. Put the money in treasury bonds, put the money in shares, the collected pool of funds. I hope I have clarified that particular question.
Yes, Mr. Alex, you have, and I think you've clarified even more questions. And I think just to maybe, because there's a lot of questions on how to decide on what to invest and and where, and you did touch on it in your presentation. Let me read for you a question here, which I think will be good for members. How does one decide on minimum returns when investing? Should we benchmark to the 1-year treasury bill?
Good question. Most investment products in the market are actually benchmarked on the treasury bill, 1-year treasury bill. Reason being, as I mentioned, treasury bill is the safest way you can invest because the government cannot default in its own currency. It owns the currency. For that reason, you know that any other product, it has to give you above that zero risk product called the treasury bill. And so anytime you're looking at investment, that's why we benchmark it with treasury bill. Again, when it comes to returns on investments, the first thing we look is there are 2 types of products. The fixed income products, those are the ones that tell you this is the return. By the time you're entering, you know the returns that you'll make. They'll tell like money market or not really like money market, like most of these commercial papers, most of these products, they are corporate notes. They'll tell you we are giving a specific percentage. So by the time you're buying, you already know the percentage. But there's a second kind of investment product like shares where you don't know. And so there's a risk associated with it. You're doing your analysis and seeing this share in the next 1 year might double. There's no guarantee on that. And so you're using a risk and there's no guaranteed return. But when you want to benchmark your performance, even in stocks, after that 1 year, you want to see, has my returns matched to the treasury bill? That can be a good benchmark for the performance of your fund or your investments.
Thank you, Alex. Moving on to the next topic, I'm seeing a lot of interest on cryptocurrency. So what is your take on cryptocurrency? Does cryptocurrency have a true underlying asset? And then the third one is there's a lot about cryptocurrency, whether it is real or fake, given the massive returns that are reported. Can you please comment? So maybe you can say something about cryptocurrency and the returns.
Yes. So you can bet that cryptocurrency is one of the, because it's trending, is one of the questions I have to keep answering, and for good reasons. There's a lot of talk around it. It's a seemingly new product. It's been there for some time, but still there's so much new about what is being called cryptocurrency. Bitcoin is just one of those cryptocurrencies, the most popular and probably the one you've had more concerning. So just to give a brief history about cryptocurrencies. So cryptocurrencies are what is being called digital money, but they start their history comes from what is called shared or what they call blockchain. Or blockchain is simply meaning that anybody who is part of their system, they use their database as the database is replicated in so many places. I think the best example is some of these places where people download movies easily. They are called the Pirate Base, where you go and download movies. So there's no central database. The database is just replicated in people's PCs and various places. And that makes it safe in a way to say. And so it's someone who came up with that method and thought, if I came up with a currency that is not under regulation, it is widely spread. It's the information is so hard to crack because it's so duplicated. And then number two, there's no central bank that regulates it. Then it will become widely used for the purposes of trading. And for some period of time, it has grown in that direction. But just to be able to say some of the advantages and disadvantages, I think the major advantage is that more and more people are adapting to cryptocurrencies. I think I saw the last PayPal is starting to trade, to transact with cryptocurrencies. More and more people are saying, you know what, I can take cryptocurrency as tender, as legal tender, as money. But the truth is that it's not widely used. And so what happens is that a lot of people who are buying cryptocurrencies, your Bitcoin, they are doing it purely for speculative reasons. So they are buying in the hope that the price will go up. And so when a currency is not being used for its real purpose, because a currency should be used for transacting, to buy and sell goods, but instead a majority of the people are holding it as for speculative reasons, such products will usually be very unstable. And that's why Bitcoin fluctuates a lot. Some small issue comes, people are selling cryptos because it's not being used to transact, to buy and sell. And so that's one of the biggest weakness for cryptocurrencies, that a majority of people are speculating and not using it to trade, which is what a currency should be used for. Another big problem of cryptos is that because there's no regulation, unfortunately, a majority of the transactions that are being used using cryptocurrencies are what is you could call are controversial. Things like there's cybercrime, things like human trafficking, drug trafficking. Because there's no regulation, these people feel safer to use Bitcoin to be able to terminate. So again, this is a morality thing. Do I really want to get into a currency whose majority of the transactions are probably what is black market or what could not be accepted in the mainstream? But given that, as more and more people adapt to cryptos like Bitcoin, the demand will keep growing because they have an algorithm that keeps the supply, coming in very little. So as the demand grows, the price of the Bitcoin will keep growing, and that could be a good thing for someone who's thinking long term. So there are some short-term advantages and some long-term advantages. So I hope I have answered it to a good extent about cryptos.
Yeah, thanks, Alex. I believe you have, and if the members have
Yes.
more questions, they will probably ask.
Mm-hmm.
The other question is again, maybe just to take you back to the treasury bonds and bills. Is there a way one can monitor the bonds and bills regularly, e.g. through a website? And then there was a question on the returns. A member was asking if the returns are 9% and the withholding tax is 15%, doesn't that incur loss? And then the last one, do commercial papers and corporate bonds have higher returns due to the risk associated in comparison to bills and T-bonds? Maybe you answer that and then we move to another area. Thank you.
Yes, I'm going to answer the last one. The corporate bonds and commercial paper, yes. In fact, they will benchmark their interest rates to the treasury bills and bonds. So if the treasury bill is at, like I've mentioned, the current 1 year treasury bill is at 9.8. They'll usually say, you know, we are giving 5%, 7%. There's a commercial paper that some time ago for Two Rivers, it was at 18%. So you can imagine that's 9% above. Real estate have good commercial papers, again, because the real estate market is iffy a little bit. But yes, they have, even for corporate bonds, they will give you a higher interest rate because of the extra risk associated with them. The second question that was asked was about when it comes to treasury bills and bonds and the interest rate. So the withholding tax is on the interest only. So when you buy a treasury bond of 100K and your interest is, say, the 9.5, which is 9,500, you'll be charged 15% of the 9,500. So the interest rate, I mean, the withholding tax is only on the interest portion of the either treasury bill or treasury bond or any other product. That includes money market products. They'll attract a withholding. Most investment products attract a withholding rate of a withholding tax rate of 15%. But that 15% is on the interest, the growth. That is what is taxed. So I hope I've answered that. The third question was on, sorry, kindly remind me the first question. I'm sorry, I didn't write it down.
The first or the third one?
The first one. I've answered with the third one and the second one. So it's the first one.
Okay.
I think it was about.
I seem to have mixed them up. But as I look for it, there's a question here on gold and gold trading.
Yes.
And what's your take on that?
So gold, again, for one, we have a gold product. It's called the Barclays Gold. That's the only one we have in the Nairobi Securities Exchange. We have a gold product, but if you are dealing in foreign markets, there's a lot of gold being sold. And their advantage, gold has been sold for the longest time, probably even longer than a lot of products that you're talking currently. And gold is usually seen as a better, it gives more real value in terms of, they say, you know, currencies keep fluctuating, but gold has a real underlying asset. So if you look at the performance of gold in the mid to long term, it maintains a certain growth rate, a consistent growth rate over a long period of time. But again, it's important for me to mention this. There are two kinds of investments when you go into online investing. There's what is called contract for difference. This is where you put in maybe $100 into an online trader. They multiply, they give you, it's called leverage. They give you maybe 10 times of that or more. They give you leverage and then they tell you to trade with that money. That what you call the contracts for difference. You are told that we will give you some leverage. The money you put is multiplied some times over. It's important to note that the risks associated with that kind of trading is much higher. And that is not really, for example, if you're buying stocks through a contract for difference broker, you're not playing in the stock market. You're playing in a market that has so much higher, more risk. In fact, a survey was done the other day and they saw that more than 82% of people who trade in this online forex trading that give you leverage, they lose their money. So you need to understand that when you're investing in a broker who tells you they're giving you leverage, they're multiplying your money a couple of times over, there's a much higher risk associated with it. I highly advise people to keep away because that risk is unless you're doing it, you know, with little money for the purpose of, you know, fun, interest. But in terms of long-term investing, you will lose your money in the long term because of the high risk associated with it. So I hope I've answered that one.
Yes, and thank you very much, Alex. Members, if I may indulge you for a second, as you can see, we are almost at the tail end of the webinar in terms of the time we had requested you to join us. I kindly request if we can just extend for like 5 minutes to wind up. I know there are so many questions on the chat, the Q&A area that may not have been answered. Our promise to you is that all these questions will be forwarded to the team. Will take them, will provide written answers to the questions, in addition to providing the recording for the webinar, as well as the presentation itself. So Alex, if maybe just to wind up, a lot of members have asked on how they can reach you if they'd want to engage your services, and whether you do, you only train or you help members invest and provide advice. So maybe just take a second to talk on that, and then I hand over to the next step.
Yes, thank you. So yes, ideally my first profession is that I'm an investment consultant. So I help people with these decisions. Whatever product that you want to invest in, we have a team that does research so that you're able to make well-researched decisions based on well-researched information. But even if it's on general investment advisory, you can always reach out to me. I have shared the contacts on the screen, but just to mention, my telephone is 0720-851058. Again, it's shared on your screen. And for my email address, you can just send it to invest@rubianiwealth.com. You can reach out to me through those two ways, and we can be able to sit down and discuss basically on whatever issues you have concerning investing. I hope that's good, Dr.
Yeah, that's good. And I believe this will also find its way as the end of the presentation. So when it's shared with members, they can also reach out to you. There were questions on two questions which were a bit interesting on partnership. So one was this may be probably provided as part of the written responses. One was on avoiding loss during divorce, and the other one was, the specific question was, is a bad partner a bad investment choice? Maybe you'd want to think over those and provide us with the answer we will share with the members. At this juncture, so as we do not take so much of the members' time, and really to appreciate the members and also to appreciate you, Mr. Alex, and as well as the entire KMA SACCO team for the time and putting this together. I'd like to invite our Honorable Chair, Dr. Kennedy Koech, to give us some final remarks and then close for us the seminar. So Dr. Karibu.
Asante sana. Thank you, Alex, for such a stimulating talk. And as you saw, we had about 380 attendees, which is really good. It just shows that there's a lot of interest in this topic of investments. And probably I was thinking that probably one of these days we would organize actually sort of like a day-long seminar where we shall also have topics on investments, so that we have enough time to cover all this. So I want to thank you again and encourage members to reach out to Alex so that you can make some investment decisions that are guided by a professional. So I hope to see you again in our next webinar, and hope to have a bigger audience next time. So thank you very much and have a good night, everyone.
Thank you. We are free to leave. The recording, the presentation, and the answers to the questions will be shared. Thank you.